Assalamu alaikum friends, welcome to lecture 17 of SBR IAS 32 Financial Instruments presentation. Now, regarding financial instruments, there are three separate standards: IAS 32, IFRS 7 and IFRS 9. IFRS 7 and 9 we are going to cover later, okay? Which IFRS 9 deals with financial instruments, the measurement and the recognition, and IAS 7 IFRS 9 deals with the financial instruments measurement and recognition. IFRS 7 deals with the disclosure, and this one deals with the presentation of financial instruments. Okay, so we are starting with financial asset. Here we are going to go through some items. You need to understand what is financial asset, what is financial liability, and equity. Then we are moving on to compound instruments. Compound instrument is a mixture of financial, is a characteristics of both equity and liability and other reporting standard. So starting with financial asset, what is financial instrument? A financial instrument means any contract that gives rise to financial asset in one entity, financial liability or equity of another entity, because financial asset of one company becomes a financial liability of another company. Asset for one company, liability for that entity, another entity, you see. So you need to know the definition of financial asset, financial liability. Financial asset, what is a financial asset? A financial asset is any asset that is cash. Financial, the word financial means to do with finance, to do with cash. Cash, any equity instrument that gives you a right to receive cash or another financial asset from another entity, or a contract. You see the word right, you have to have a right to receive cash, either cash in direct form or through shares, but you have to receive it. Contractual right to exchange the financial instrument with another entity that is favorable to the entity, or a non-derivative contract. See, contract needs to be non-derivative. If it's a derivative contract, you deal it using the way of dealing with a derivative contract is different from the way you deal with non-derivative contract. Derivative contract and all, we are going to cover it in IFRS 7, IFRS 9 later on, which is a big huge standard in itself, right? But for now, a non-derivative contract for which the entity is or may be obliged to receive a variable number of the entity's own equity instruments. Okay, if you're not understanding the meaning of it, it's fine. Through the question will you will understand it better. Okay, moving on to financial liability, just change the word, everything else remains same. How we have defined financial asset. Okay, now it is not a contractual right, now it is an obligation for you to deliver the cash or another financial asset, or you to deliver another financial asset to another entity. Here also is the same thing, but obligation to exchange financial instruments, conditions which are unfavorable. Third, non-derivative contract again is the same thing. This time is to deliver. Earlier it was to receive. That's it. That is the older thing. Equity. What is an equity? An equity instrument is any contract that evidences a residual interest in the asset of an entity after deducting all of its liabilities. Okay. So, interest, dividends, losses, and gains. The way you deal with the interest from that financial asset or liability, dividend, the losses, the gain, depends on how you're treating that instrument itself. For example, if you're receiving a dividend from a preference share, and that preference share, if it is classified as a liability, then that dividend will be charged as a finance expense in profit and loss. Because for any liability, we charge interest, right? Finance interest. Interest which goes as a finance expense. Same way, if the dividend is paid on shares that are classified as equity, then it will be reported in the statement of changes in equity. Offsetting. What about offsetting? You have a financial asset, you have a financial liability. Can you offset? Can you minus financial liability from financial asset and show the net position? No, you are not allowed to do that. But under two conditions, you can do it. What are that? Number one, if you have a legally enforceable right to set off the amount, or you settle it on a net basis. Your intention is to settle on a net basis, or to realize the asset and settle the liability simultaneously, where you are doing it simultaneously. In this two condition, you can net off. Otherwise, you do not offset. You show financial assets separately, you show financial liability separately. Moving to classification. See, for your IFRS 9 and IFRS 7, this standard is very important. You first need to know what is financial asset and liability, okay? So please go through this carefully, because when I go to IFRS 9, I will be assuming that you already know classification, you already know what is financial asset and liability. I'm not going to repeat it there, okay? So classification. Financial instrument could be either liability or equity, okay? But the way you classify is going to have a major impact on the financial performance and the position. How? We'll see. If you classify an entity as a liability, what happens? If it's a liability, your gearing will increase. Gearing will increase means you are financially more risky now. You understand? So on that loan, on that liability, you have to pay interest, which goes as a finance expense in your profit and loss. Therefore, your profit and loss also will reduce. And because your profit and loss reduces, earnings per share also will reduce. Are you getting the point? If you classify it as an equity, gearing will fall. Gearing will fall. That means you become less risky now. And any servicing of finance is charged to retained earnings directly. That means it is not going to affect your profit or earnings per share. Understanding? Compound instrument. Compound instrument means it has characteristics of both debt and equity. Compound of both debt and liability. Right? One example is, let's say you have an instrument. What is it? You have a debt. Okay? You have a debt that could be redeemed either that could be redeemed in future either in cash or fixed number of equity shares. That means your debt, you can convert it to cash or fixed number of equity shares later on. Presentation. How do you present compound instrument? Compound instrument needs to be split into two components. One, financial liability, two, equity. Financial liability means the liability to repay the debt holder in cash, and equity is the option to convert into shares. Okay. These two elements must be shown separately in the financial statements. You cannot show them together. And how do you initially recognize this? Split up. Split it into liability and equity component. How do you start? Always with the liability component. First, liability component. This is the first thing you have to work. Why? Equity component is the balance. Okay. How do you calculate the liability component? It is calculated as the present value of the repayment and discount at the market rate of interest for a similar instrument without conversion right. They will give you that. They will give you all these things. They will give you the present value. They will give you the repayment. They will give you the discount rate of an instrument that is, they will give you the discount rate of a similar instrument, but without the conversion right. You cannot convert because you only want for the liability component, entirely liability. Second, equity is the difference between your cash proceed from that instrument and the liability component. That's it, balance. We'll be doing questions. Okay. Now moving on to reporting standards. 3 different accounting standards dealing with financial instruments. Just one financial instruments alone. You see, there are no other standard that has so many standards just for one thing. For everything there is only one. But this topic, financial instrument itself alone, has 3 separate accounting standards to deal with it. IAS 32 presentation, IFRS 7 disclosure, IFRS 9 the measurement, recognition, everything. Because this area is that complex and it's so important. That's why they are very strict on this. That's why they have given you separate 3 accounting standard. IAS 32 deals with classification. Whether you need to classify it into liability or equity. That is done. We have done it in this. IFRS 7, which is only on the disclosure part, again is a very small standard. And IFRS 9, the main initial and subsequent measurement of financial instruments. Now we'll be doing questions before we summarize IAS 32. Test your understanding 1. In this, you have been given 3 types of preference share, and you need to discuss whether they should be classified as financial liability or equity. Okay. So the first one is 1 million preference share for $3 each. Okay. No dividends are payable. They will redeem the preference share in 3 years' time by issuing ordinary shares worth 3 million. The exact number of ordinary shares issued will be based on their fair value on 30th September 2006. So they don't know the exact number of ordinary share in the first one. Now tell me whether this 1 million preference share, will it be taken as a liability or an equity? I'm not writing the answer. You can read the answer. The answers are there given in the textbook. But what I need to know is, right? What you need to know is, how do you classify? How do you start? Go by the definition of financial liability. Start with the definition of financial liability. Okay, so you start with definition of financial, and once you do this is only the first time you have to do. For this the second two, you don't have to define. Every time you don't have to define what is financial liability. Definition of financial liability. What is the definition? Tell me. I'm not writing the answer there. It's there already. I've covered it in my slides also. What is the definition? Any contract. Okay, the definition is any contract that may be settled in a variable number of entities' own equity instrument. You are going to settle it in what? In variable number of entities' own equity instruments. So it should be variable. The keyword is variable. Number of shares. Not fixed. If it's fixed, it's not financial liability. It needs to be variable. Okay. So now you see whether this one is a variable or not. You have to link this to the case study. Okay. So you'd see here they don't know the fixed number of ordinary share. It's variable. You don't know the exact number of ordinary share. You will only know it on 30th September 2006. You see, it's variable. So therefore, okay, this is a debt. This is a financial liability, not an equity. Because if it was equity, it should be fixed. For equity, it has to be fixed number of shares. And for financial liability, it should be variable. So this one is a debt or financial liability. I will write FL because variable number of shares you need to issue. Coming to the next, the 2 million. The 2 million preference shares for 2.8, no dividends are payable. Preference shares will be redeemed in 2 years' time by issuing 3 million ordinary shares. How are you going to redeem this? By issuing 3 million ordinary share. This time, it is an equity. It is an equity, equity instrument. How? Because you are having a fixed number of shares. Fixed, it's 3 million shares. This is fixed. You are going to settle it by having your own equity instrument. That is fixed number of equity instruments. So this should be classified as equity, right? Coming to the third. 4 million preference share for 2.5 each. They are not mandatorily redeemable. A dividend is payable if and only if dividends are paid on ordinary share. Tell me, is this here? The definition is not about fixed number of share or variable number of share. Here it is about the obligation to pay dividend or not. Okay, see, financial liability also has another definition. What is it? Contractual obligation. Contractual obligation to deliver cash or other financial asset. right? You can fill it. But in this case, do you have the obligation to repay this instrument? No, you don't have an obligation. You pay a dividend if and only if the dividends are paid on ordinary share, then only dividend is payable, otherwise it's not. So you don't have an obligation. You understanding? There is no obligation to pay the dividend on ordinary share. Do we have an obligation? So there is no obligation to pay dividends on this preference shares also. Therefore, this is equity. Even the third one is classified as equity because there's no obligation. Okay. So now we'll be moving on to the next question. Illustration 3, compound instruments. How are you going to account for this? Okay. So you have been given a 3-year convertible bond, which is at 50 million. There were no issue cost. Coupon rate is 10%. Okay. Payable annually in arrears on 31st December. Bond is redeemable at 1st of Jan 2004. Okay. It's a 3-year, right? Bondholders may opt for conversion in a form of share. The term of conversion are 225 cents equity share for every dollar owed to each bondholder. Bond issued by similar entities without any conversion right is 15%. Assume that all bondholders opt for conversion in right. How are you going to do for this? You need to do this in 3 steps. Step 1. There is an equity portion to it and a liability portion to it. So you need to split it into financial liability and equity. First, you always have to start with the liability. Financial liability. How do you find it? It is simply the present value of cash repayment at the market rate of interest. So you first have to find the present value of all your cash flows of that bond. That is your starting. With the debt, you have to start. Debt is the bond here. What are the present value for the 3 years of that bond? You have to find the present value of it, right? So that's what we are going to do now. So let's start. Okay, for this, okay, date is very important. Okay, then comes the cash flow. Then we have the discount factor. With at what rate? At 15%. You always have to take the rate without any conversion rate. You have to take that interest always. Whenever there's a compound instrument, you have to discount at what rate? The rate without conversion rate. That is 15%. Don't take 10% coupon rate and start discounting. And present value. Okay. Now, starting with 31st December 2001. At this date, you will be giving interest. Then 31st December 2002, also interest. 31st December 2003, also interest. And 1st of Jan 2004, it is the principal amount. Because it's a bond, right? Bond is it's a debt. So for debt, we are paying interest and then at the end, the principal amount. Because they told owed till 1st of Jan 2004. Okay. So you have to take the coupon rate to get the cash flow. See, when you have to get the interest, look at the coupon rate. This is 10%. 10% on which amount? On the amount given 50 million. So if you take 10% of 50, it is 5,000. Understand? So interest will be 5,000, 5,000, 5,000, and finally principal will be 50,000. Discount factor is at 15%. Okay, so once you do that 15%, how are you going to do it? You can use the discount factor table given to you in the exam. It will be given to you, right? In your exam, the formula, the table, discount factor table, everything will be given. In case, if you want to know how to do it manually, that also you can do. This is how you do it. 1 divided by 1.15 to the power 1 because this is for the first year. This, there is no. Okay, it will be 1 only. I'm sorry, it is here. Okay, this will come here. 1 divided by 1.15 to the power 1. Let me erase it. This is based on the number of years. Okay, 1 divided by 1 plus that discount factor, that is 15. Then this will be 1 divided by 1.15 to the power 2, 1 divided by 1.15 to the power 3, and this will be 1 divided by 1.15 to the power 3 is still not 4. This is just 1 date difference. Still you will be taking this only. Third year only you are paying the interest as well as the principal. You have to take the third year only. Okay. So now when you discount, just multiply. In Excel you can do it very easily. Just multiply the cash flow column with the discount factor and you will get your answer, which is 4347.8, 3780.7, 3287.6, 32875.8. You add up all, okay, you'll be getting 44291.9. So this part is your component. And how are you going to get your equity component? Just minus it from 50,000, which will be just the difference, 57081. 50,000 minus this. Okay, you might be thinking why this is a positive. It is this minus this 1 minus 2, which is equity, which is 5708.1. Equity will always be less than liability. Liability is the bigger portion, right? Because equity is just the remaining, it's the balancing figure. Now what else do you need? Tell me. You need to measure. This need to go in your statement of financial position. So second step is measuring the liability. At amortized cost. You are going to learn further why it is at amortized cost in IFRS 9, which we have not covered yet. But just know most of the liabilities are measured at amortized cost. Okay. So now amortized cost means this is how you have to do. You start with the date, opening balance, the finance, the interest, which is the finance cost, payment. Because for this bond you have to know what is the closing balance of this bond after you have done all the payments and everything. Okay, so date will be 2001, 2002 and 2003. How are you going to get your opening balance? It is this liability component. You see, this is your starting place. You always have to do the steps. 44291.9. Am I right? Yes. You cannot go to 2002 because your closing balance in 2001 will be the opening balance in 2002. Understood? You have to go like this. You have to go horizontally, not vertically. Horizontally across, not downward. So then interest is at 15%. You have to always take the interest at this rate, the rate without conversion, that is 15%, right? So 15% on this amount. On which amount? 44291.9 will be 6643.8. Now the payment will be 5,000 only, the coupon that you have done. Deduct your payments because from this amount of bond you are paying 5,000. You understanding? And this finance cost, this interest will be added with this opening balance. Then you'll be left with 45,935.7. Now this becomes the opening balance here. This becomes the opening balance here. It's like that. So now 45,935.7. I will show you a magic here. On this, take 15%. It will be 6890.4. Again 5,000. It will be 47826.1. Take that here. 47826.1. 15% on that will be 7173.9. Deduct 5,000. You will end up with 50,000. This is the magic. Your closing balance should be 50,000. It's 50 million, right? Because we are dropping the 3 zeros. Exactly what you have started with here, 50. It's 50 million actually, dropping down the 3 zeros. After that, the third and the final step will be conversion of the bond. You need to convert that bond. We cannot just deal it with it as a bond. After converting, what happens? So here, you see, carrying amount on 1st of Jan. Carrying amount at 1st of Jan 2004 will be equity liability. Equity will be how much? Already we have calculated in step 1. And liability will be 50,000. This is the bond that you have taken. Together, if you add, it will be 55,708.1. Okay. On this date. Now, after conversion, what happens? Conversion are to 25 cents equity share for every $1, right? So how many shares are there? Equity shares, you see, they issued 50 million. So this 50 million, now you're converting it into shares. So it will be 50 million into 225 cents. So 50 million into 2. Because they told 225 cents equity shares. First multiply the 50 by 2. Okay, it will be 100 million. This is 50 million, okay, by the way. 100 million shares. Okay, which will have a nominal value of, if you multiply this with 25 cents or 0.25, it will be 25 million. This is the amount. The worth will be $25 million. Understand? But what is the total share? Tell me. It is this. Out of this, okay, now you have 25 million shares. So the remaining, that is, see, I'll show you, 55,708.1 minus 25,000 will be how much? It will be 30,708.1. So the remaining, this will be classified as what? Share premium. There is no remaining liability. Why? Because after, when you convert it into shares, there will be no liability. So double entry will be you need to debit other components of equity, debit liability because liability will go, credit share capital and share premium. Okay, how much? In your equity earlier there was this many equity, right? You need to debit it. You need to remove this out now after conversion. Liability also will go 50,000. In your share capital it will be now 25,000. And share premium will be 3708. So that's it. Now we'll be moving on to the next question. Test your understanding 4. This is the last question for this lecture. Okay, here you are given two situations. First one, where the holders elect for the conversion. Second, no holders elect for the conversion. Okay, so we'll see how the scenarios differ when under this two. Here you have issued 100,000 for person 3-year convertible loan on 1st of Jan 2006. Market rate, that means market rate interest for a similar loan without the conversion is 8%. That means this 8% you have to use as a discount factor. And conversion terms are one equity share for every $2 of debt. Conversion takes place on 31st December 2008. If you check from 1st of Jan 2006 till 31st December 2008 is 3 years. 2006 the whole year, 2007 and 2008. This is the question similar to what we have done previously, the previous question. Okay, so quickly we can do this. I think in 2 minutes we can finish this, right? Especially the part A with the election, with the conversion. So I told you the 3 steps. Those 3 steps also only we need to follow. Quickly we'll do that. Okay, split the proceed into financial and equity. First, starting with financial, right? So here you have the date, cash flow, discount factor, and the present value. Okay, 31st December 2006, 31st December 2007, 31st December 2008. So you are giving interest and principal. You can add them together or principal separately also you can show. So here you see it's 4% on 100,000. So 4,000, 4,000 with 100 add 4 it will be 104,000. Discount factor is 8%. So it will be 1 divided by 1.08 to the power 1, 1 divided by 1.08 to the power 2, 1 divided by 1.08 to the power 3. Multiply both cash flow with discount factor. The present value will be 3429, 82, 559, add up 89, 692. This is the liability component, or you can label it as A. Okay, then we have B. B is 100,000, the proceed, and equity is B minus A. It is B minus A, which will be the balance 10,308. Get it? Now we are moving on. This is the first stage. Second stage, splitting components. Splitting to equity and liability. Done. Once it is done, next is amortized cost, right? Because it's a debt, it will be at amortized cost. The table that we did, where at the end you have to get 100,000. Opening balance, date, cost, that is your interest, okay? Cash, paid, and your closing balance, CB. So here it is 2006, 2007, and 2008. Opening balance, you start with 89692. This one, A. You start with your A. Then your cost will be, take 8% on that opening balance, 7175. This will be 4000. Already we have taken. So here it will be 92867. Bring forward 92867. It becomes the opening balance of the next year. Take 8% on that, 7429. Again 4000. Deduct 96296. That becomes the opening balance for the next year. 8% on that, 7704. Then 4000. Hold the interest. Then you will be having 100,000. You see. Now third is the conversion. Okay. So equity. Okay, 31st December 2008, in your statement of financial position, equity or liability. Equity will be 10,308, the balancing figure. Liability is 100,000. See, we already did this separation. You might say that liability is 89692. No, we already did that to find equity. Once we find equity, liability will be 100,000. Okay, so it will be 1110308. Now with conversion, what is it? They told for one equity share there are two debt. So this is a debt. 100,000 is a debt. So divided. For one there is two debt. This is debt. This is equity. So in case if you want to find equity, so debt is 100,000. If you want to find here, just divide it by 2. So 100,000 divided by 2. You will get the equity, which is 50,000. Okay. For two debt, one equity. So 100,000 debt, it will be 50,000 equity. So this many shares are issued. You see 50,000. So out of this 110,308, 50,000 is issued as equity capital. The balance, which is 60,308, this is share premium. Got it? Now we are moving on to part B. That is redemption. You redeem it because you don't convert. You don't elect for conversion. So you redeem it entirely. In part B, what do? So carrying amount at 31st December are the same as under 3A. This carrying amount will be same. Okay. On redemption, what happens? This 100,000 will be wiped off entirely because you are paying it by cash. But equity will remain. This equity 10,308 will remain. Equity will go because of the cash payment. That's it. So that's it for this. Now we'll be summarizing IAS 32. So in IAS 32, we have covered three things: financial asset, financial liability and equity, compound instruments. Financial asset is a contractual right to receive cash. Financial liability is a contractual obligation to deliver cash. And equity is the balancing figure, right? It is the residual interest after deducting liability from asset. Coming to compound instrument. I'm sorry. So compound instrument means it has both the feature of debt and equity in that instrument. For example, a convertible bond, a bond which you can convert to shares, right? So in that, when you're working out with compound instruments, you first need to find the financial liability component. How? By calculating the present value of that repayment discounted at the rate without the conversion. And then you find the equity component, that is the balancing figure. We have just done question on this, right? So that's it for this. Make sure that you do questions on financial instruments. You will be better able to know once we are done with IFRS 9 also. But don't wait till I finish IFRS 9. You still can do at least the compound instrument part you can do. You don't need IFRS 9 for it. Right? So that's it for this lecture. Thank you for watching and see you in the next lecture. Meanwhile, don't forget to subscribe to my channel if you are new to my channel, and take care.